Good afternoon, everyone, and welcome to another edition of Unlock the Stock. Today, we're hosting the South African REIT Association in a special session on the local REIT market, which will include everything that you need to know about investing in this particular market and the benefits of the asset class. We're pleased to welcome Keillan and Ndlovu, who will take us through that sector, and there is so much background research and information that he is providing. I think it's going to be a really good session, so please get your questions ready. He's here to answer them. Unlock the Stock is only possible with our technology partner, Lumi Global, and their website is lumiglobal.com, where you can learn more about their various online and investor presentation solutions that they have. Our hosts today, as usual, will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they will be facilitating the Q&A session. Before we start, there are just a few housekeeping notes. Keillan will take you through a presentation which will be followed by a Q&A session. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel next week. You will see an email when we begin the Q&A session, and if you would like to be added to the South African REIT Association database, please send them an email and ask them to load you onto that database. And so, a quick introduction to Keillan. Keillan started out as a banker and then became head of property funds at Stanlib, including the award-winning Stanlib Property Income Fund. Today, he is an independent property analyst and a guru on everything related to property. So on that note, Keillan, I am ready for you to share your screen and to please take us through your presentation.
Thanks, Vanessa, for the introduction. I'm loading my presentation now.
I see it.
Okay, good.
Excellent.
Okay. Good afternoon, everyone. Thank you for attending, and thanks to the Unlock the Stock team for the invite, and SA REIT Association for inviting me to speak on listed property, SA REITs, on an independent capacity. So there's a lot to talk about, lots to cover with the market. I'll do like a top-down research and then bottom up and touch on some of the stocks as well, and give you a sense of where the market has come from and where it is going. But before we do that, it's good to give you a sense of the members of the SA REIT Association. You can see some of the images here. Some of them may have seen as you're driving past shopping centers or on the street, or to let signs or fully let signs as well. These are the members of the REIT Association. They've got different exposure to property. Some have retail exposure, metropolitan, non-metropolitan. Some are in the offshore space as well. Then they've got offices, you've got residential, there's storage. So it's an association, and it's good to be part of an association. It helps us as analysts, given that they work together, they've standardized reporting, so it's easy to get information, and we can compare that on a like-for-like basis, be it NAVs or FFOs, ICRs as well. And we've seen a big improvement in terms of disclosure, in terms of governance, and then alignment of information. We've got one that's not a REIT member at the bottom, that's Fortress, because they enjoy being part of the alliance. They used to be a REIT, but not a REIT at this stage. So let's just go to the basics. What is a REIT? A REIT is basically a property investment vehicle where there's a tax dispensation that allows a flow through of income before tax. So the tax is at the hands of the investor. And looking at the JSE, we've got listed REITs, lots of them, I'll touch on them. So the minimum required is 300 million rands worth of property, and you have to keep your debt below 60%. The most important thing is that at least 75% of your earnings or income has to come from property-related activities. So it can be from direct properties, or you can invest in other property companies or listed funds. And the rule is that you have to pay out at least 75% of your earnings, taxable earnings, to investors each year as distributions or dividends. Some of the REITs choose just to pay one big lump sum at the end of the year, and most of them, they pay twice a year. And I mentioned governance earlier on. There's committees to monitor risk, governance, audit, everything basically. And risk can either be internally managed or externally managed. So we'll move on to the topical issues. Probably one with the JSE. We've seen lots of listed funds, delist or companies, but the listed sector has been mostly to do with mergers and acquisitions, M&A activity. There's been one or two delistings. One of them has been Liberty 2 Degrees last year, a couple of months back. But most of them have been mergers and acquisitions. And we've also had some stocks that have got an A and B structure, merge those structures into one. That's why you see the decline in the number of stocks. But then there's a variety of stocks that you have. There's 35 local focused property companies, 29 REITs, and then 6 are not REITs. And then also you have offshore exposure as well, offshore counters. Most of them are from the UK. And then we've got Central and Eastern Europe as well that you can access through the JSE. So quite a diverse number of stocks. So you can buy them directly if you understand the market, you've got the research knowledge, or alternatively invest in some of the unit trusts. Almost every major asset manager has a property specialist product investing in these companies. So what's happened lately? This has been quite topical. So we'll start with the good news, then we'll go back as well, look at history, what's been happening with the sector. But lately, the momentum has been positive, been supporting the property sector. At the end of October last year, we saw the property sector bounce back quite strongly, mainly on the back of the Fed signaling end of interest rate hikes. And then post that, you saw the market cool off a little bit. And then we saw institutional buying come through, mainly the PIC, that's the Public Investment Corporation, and they've bought most of the listed counters with Growth Point 20%, Redefine at 20%, SA Corporate 22%, Fortress as well above 20%, so NEPI as well at 16%. So what we've seen them increase the allocation. That's helped to support the market. They were first in as institutional players, and then the market cooled off a little bit. Afterwards, with elections coming through, lots of uncertainty. And then post the election outcome with the GNU, they saw the market rally. And it was a rally across basically all sectors and asset classes, and property benefited as well in turn. So the momentum has been quite positive for property. And if you look at that from that bottom to the top, that's a 30% increase in share prices. Let's look at from a total return perspective. I've split that into different periods. There's 1 year to date. So that is courtesy from Anchor Stockbrokers, 9.6% total return year to date. Property is the best performing asset class this year. And then June as well, it was the top performer, and over 1 year with 26% total returns, income and capital. And 5 years, not looking so good. So you saw that recovery is off a very low base over 5 years, and 10 years as well, still quite low, and 15 years slightly higher, closer to the bond sector. So that's what we've seen year to date, quite strong over the last year. And the big question is that will that momentum continue? We'll talk about that later on. So it's nice to look back as well. So before 2018, the sector was quite strong. In fact, from the time I joined the property sector in 2004, we're so used to property sector delivering double-digit 20, 30, 40% total returns. And that happened up until end of 2018. So the trigger there for the decline in share prices was mainly around the resilient stable of companies then, where there were concerns around corporate governance, there were accusations of insider trading, market manipulation. But all those allegations were unfounded. The FSA did the investigations, and the group was cleared of all those concerns. And there was so the market took time to recover. As the market was trying to recover, we had economic growth slow down. There was oversupply in the office sector. As we thought the market has probably reached the bottom in 2020, then COVID hit, and you can see that sharp decline in share prices. And when the market looked cheap, started to recover, then there was looting. So lots of looting in KZN and Gauteng in the shopping centers, and then saw the market fall as well. and started to recover again, and then load shedding hit. And then after load shedding, then interest rate hikes. So the sector's been quite through a lot. And then you can see that recovery at the end of 2023, running up to 2024. So the interesting thing about this chart is that if you look at the JSE, it's been hitting all-time highs lately, whereas property sector is still trading at the 2010 levels. And some share prices even below 2010, at 2009 levels as well. This is a chart, a table rather from Century Capital, just give you a sense. So I've started from 2018, from the toughest times the property sector had. As I mentioned before 2018, the sector was doing quite well. And so 2018, 19, 20, property struggled. 2020 was COVID, and then recovery in 2021 of a low base, 2022, interest rates, and then 2023, the best performing asset class locally. And at the top, you can see that there was a big shift into global, so global equity, cash, the ones that have been outperforming, and property year to date done quite well. So the challenge is that with the retail sector, I mentioned the institutional sector where there was big buying. The retail sector, which is individual investors, they haven't been investing in the sector since 2018, basically. So we haven't had inflows from unit trusts from 2018, and last year was the worst year in terms of outflows, 3.2 billion net outflows. Sadly, at the wrong time when the sector was the best performing asset class. And same as well, year to date, there hasn't been much money coming from retail investors. Numbers up to end of Q1, waiting for the Q2 numbers. They'll be out in mid-August, but you can see the momentum in the retail space has been quite long, and retail investors have missed out on the recent rally in the sector. So with lack of inflows, it became a challenge for the sector. During the good times I mentioned earlier on, mainly before 2018, the sector could raise new equity. And most of this equity was through accelerated book build instead of rights offers, which can take time, or rights issues. And these issuances were usually oversubscribed within a few hours. Didn't take even 2 days. And you could see that it was easy for property companies to grow their portfolios, to invest in offshore markets as well. But then we've seen that decline from 2018, not much equity raised in the sector. And most of that has been dividend reinvestment as opposed to book builds. But the picture is not looking so bad this year. You can see the momentum start to pick up on the left-hand side. We've seen Lighthouse do a scrip dividend issue, and they've raised almost 200 million rand. Vogile as well, Equites, and NEPI. So there's decent amount that's being raised by the sector at probably discounts of 3 to up to 5%. On the right-hand side as well, book builds. Vogile is the only one so far in the local space to do a book build. They're looking for expansion opportunities in the offshore markets. And then Sirius, last year they raised 165 million pounds, and then last week they raised 150 million pounds. So very subscribed. So the interest is coming back into the sector. And we'd like to see this trend of scrip dividends or dividend reinvestment alternatives continue into the rest of the year. This is probably the busiest slide in my pack, but it's important to talk about this because in a high interest rate environment, there's concerns around the LTVs in the property space, concerns around cash flows. But looking at this slide, it just shows you how resilient the property sector has been, with interest rates going up almost 500 basis points. And the LTVs, most of them nowhere near the 50% levels, where the banks require, actually the covenants with the banks 50%, and then the interest cover ratio 2 times. So despite all that, the property sector is held up. Let's focus on the left-hand side. These are the companies that are probably facing more challenges. SAREIT, they're on 4Ways Mall. We're still waiting for their results. They've been postponed. 4Ways Mall is a challenge, and the LTV is high, and they've been working with the banks to fix the debt covenants, as well as Delta Property Fund. They focus on government tenanted buildings. Mass is a solid business, doing very well, but I guess they've been caught up with the debt markets in Eastern Europe. It's been quite tough, or basically closed, and rates have been going up quite a lot. Those stabilizing now, so they withheld dividends just to be comfortable. And then on the partial payout, the minimum required by the REIT legislation is 75%. So you can see that the range is anywhere between 75 and 98%. Most REITs are paying out and then they're retaining some of the money, either to pay off debt or to do maintenance or capex in their portfolios. And then on the right-hand side, they're the ones that pay 100% of the earnings to investors. So with interest cover ratios, still comfortable. And then LTVs need property values to fall by 20-25% before breaching debt covenants. So from that perspective, quite comfortable with the balance sheets in the property space. And it's been a challenge as well for the sector, as I mentioned, higher interest rates. It's not only that as well. The sector has gone through another challenge of rising rates and taxes and electricity costs. Maybe looking on the pie chart on the left-hand side, you can see that the biggest portion of operating costs is electricity costs, as well as property taxes, and adding other municipal utility charges, that number goes to 60%. And that's quite a big number, and it's been growing at double-digit levels, more than inflation, and it's been a challenge for the sector. They can pass that through the tenants, but not all of it in some instances, and that makes it difficult to negotiate higher rents given these charges. And on the right-hand side, you can see that municipal charges as a percentage of gross income or your rental income has more than doubled over the last 15 years. And that's where the sector feels that pain in terms of higher operating costs. And then it's building and fabric maintenance, that's like your generators as well. Lots of installations over the last year to 2 years with load shedding. So as a result, you've seen the earnings probably below inflation over the last year to 2 years, so 3, mainly because of COVID, and then higher rates as well, and higher operating costs. So big divergence in the sector. So it's only a few at this stage that are above inflation. That's SA Corporate, Safari, and Attag. And then most of the REITs probably below 5%. And then some cannot give guidance at this stage, but Fortress, it's only because of the structure they've got this year, that they've merged the A and B units, but going forward, they're expecting stronger double-digit earnings growth in 2025. And then we have the ones that have got negative growth as well. It's mainly because of higher interest rates. And it shows when you look at net operating income. So if you strip out interest rates, you find that net operating income for the sector is still positive at about 4% on average. So that's why when you look at this chart, it just shows the direct property, that what are the yields in the direct property space compared to the long-term bond yield. You can see that huge divergence. I guess to answer this question, the property sector in South Africa is probably more insulated from global trends, whereas your bond yields, they tend to follow what's happening externally, as well as South Africa being downgraded as well into junk status. And the other point as well to consider is that we've seen transactions happening at these levels, at the 8% levels to 9%, where the properties are exchanging hands at those levels. And valuers tend to look through the cycle, as I mentioned, that you've got positive NOI growth going forward. And 2024 is probably the most challenging year, and we believe 2025 will be much better. And then talking about retail sectors, still on the topic of NOI growth, the retail sector is doing quite well across all segments, basically. That's the annualized trading density growth. That's the sales divided by the square meter size of the malls. And to give you a sense of what those definitions mean, super regional is malls above 100,000 square meters, for example. That should be the Sandton Cities, Mall of Africa, Canal Walk, Gateway. And then your neighborhood shopping center is one that's close to where you live, where you go and buy bread and milk. And those have been doing quite well. And then your regionals are shopping centers above 75,000 square meters. So across the board, retail sector has been picking up. You can see that pain in 2020, mainly because of COVID. And the other measure that we look at is your how much is your sales as a percentage of so your rent as a percentage of sales, and that number is quite low. It's fallen to like 2012 levels at about 6-7%. So it's actually cheaper now for retailers to rent space compared to the last couple of years, which creates opportunities for retail landlords to increase rent. There's some of the examples. Take these pictures. I like to drive around and see what's going on in the property space. On the left-hand side, that's in Soweto, that's Dobsonville. I was just driving past here, then it was not even month end, because normally these centers have benefited a lot from social grants. And then I just saw a queue, then let me just go inside and see what's happening there. It was a day before the schools open. That's a queue to PEP. So the queue was so long that they had to say other people have to go and stand outside. And those centers tend to do quite well. On the right-hand side, that's Soshanguve Crossing, as well. I don't have the pictures to show you. Month end, the queues to Capitec are unbelievable as well. They have to tell people to stand even in those corridors leading to the bathrooms so that they don't disturb other shops. So these centers continue to do quite well. And some of the companies exposed to this will be Safari, you've got Exemplar, there's Resilient, and then Fortress to a certain extent. Dipula as well invested that, and Fairvest. The office sector is one that's been the most challenging, the most unloved sector. We saw vacancies go up to close to 20% at some point, and they've come down to about 14.2% from the latest numbers from SAPOA, and you're seeing rental growth starting to turn positive. Those are average numbers, but it's been quite challenging from some of the companies where they're still experiencing maybe 5-10% decline in rent, but they are able to let space. On the right-hand side, that's a picture, just shows Growthpoint's sign there. Growthpoint's got big exposure to Sandton. For example, they've seen vacancies fall from 29% last year in Sandton area to 19%. So there's a sharp decline in some of the areas as well, though rents haven't actually grown much positive. But the most important thing is that vacancies are coming down. And the other point to consider as well is that if the economy turns positive, there's limited supply coming through as well. There's not much construction in the office space unless it's pre-let. Then move on to the industrial sector. The industrial sector has been the best performing sector in the property space with the lowest vacancies. That's the red line on the left-hand side. Continues to do well, and can see the vacancies continue to decline. Even in terms of rental growth on the right-hand side, you've got all the different sectors. The industrial sector as well has been an above average performer. And that's one of the sectors benefited quite a lot from increase in online shopping, mostly logistics and warehousing. And you can see now there's a new sector that's come up. It's the residential sector with the launch of SAMRA, which is South African Multi-Family Residential Rental Association, which was launched earlier this year. There's going to be data on the residential sector. It's just a picture of just show some of the assets in the industrial market. These are pictures I took in Lindro Park, along Meadow as well. There's many players there in the listed space, mainly Equities Property Fund. Fortress is there as well. Then you do have other players as well, like Growthpoint as well, and Redefine as well to a certain extent. As I mentioned earlier on, our industrial sector is not manufacturing or not, it's mostly logistics or distribution and warehousing. And these assets have to be well located, whether close to the airports, close to the harbor, or close to the highway. And previously it'd be close to railway lines as well, if where they still operate. Yeah. So the listed sector, looking at the metrics, some of the key metrics that investors have to look at. Loan to value ratios, as I mentioned, this is a weighted average. The different companies have got different rates, but the average is about 40%. And covenants sit at 50% to 55%. So very comfortable for the sector given where the market is. And then interest cover ratios on average about 2.3 times, and bank covenants sit at 2 times. So still a very comfortable position for the sector when it comes to interest cover ratios, mainly because we've reached probably the peak of the interest rate hiking cycle. And then maybe going forward, we don't know when, could be this week or probably later on, but I think we've seen probably the worst of the interest cover ratio numbers. And the discount to NAV is still big at about 35% despite the recent rally. So it's important just to look at that as well, that assets are exchanging hands at book values. We've seen disposals. I did an exercise last year, working on a new one now. We saw the sector sell about 6 to 7 billion rand worth of assets last year at or around book value. And then looking at the yield, this is the yield that's actually paid out to investors. So over the last 12 months, historic yield is 10.5%. So it's different when you look at your distributable income per share yield, that's about 12%. So people can say property is trading below bond yield. So it depends what measure you're looking at. If you're looking from a distributed income per share yield, it's higher than bond yield. But what people are looking for is the earnings growth. This number has to turn positive for the sector. And looking at my forecast, this year, -3 to -4% earnings growth for the sector. And then we're looking at that stabilizing somewhat, turning positive in 2025. And then in 2026, we expect these numbers to go back to inflation or above inflation levels. And then how do we conclude on the sector? So the sector is going through a lot of challenges, as I mentioned earlier on, but we're seeing a couple of green shoots. Probably the most positive one, most talked about, is the GNU. So there's a lot of things to factor in there as well, because business confidence, and business confidence leads to economic growth. That's employment creation as well. And more so in our sector as well, the sector has suffered quite a lot from the inefficiencies within the municipalities and Department of Public Works as well. So I guess with the new government as well, you could probably see an improvement in that space, and that will help the sector quite a lot. Fundamentals are improving across all sectors. As I mentioned, retailers, for now, their rents are much cheaper than where they were before compared to their sales. And then office market, people going back to the offices as well. It's difficult to work from home, whether it's electricity or just disturbances or construction going on. Just give you an example. I've got some neighbors doing a refurbishment. I tell them, can you please stop doing that between 12 and 1, because it's just noisy. Whereas if you're in the office, it's easier to work and then collaborate and work with other people. And then high interest rates, that's the most important point here, is that rates have gone up almost 500 basis points. And we believe that's almost fully in the numbers for the property space. But then it will take time to see that big jump in earnings growth, because it's still going to be able to, you still renew at higher levels than before, even if there's rate cuts, unless there's aggressive interest rate cuts. But going forward, that should help, that you've seen the full cycle of the rate hikes, and then that will help going forward. And then declining bond yields, they help with the debate around bond yields versus property. So direct property market doesn't just adjust quickly to rising bond yields or falling bond yields, but the share prices do adjust to that. You've seen bond yields strengthen by about 150 basis points over the last month or so with the GNU, and then rate cuts will help as well. And then load shedding, we've had 110 days of no load shedding, and that's positive for the sector in many ways. One, you're not spending on diesel anymore. As well, there's no lost trade. People still go to the shopping centers. Whether it's tenants, retailers, they don't have lost kind of goods where they lose out on sales because they have to throw away some of the stuff as well. And there's less crime when there's no load shedding compared to when there's load shedding as well. So there's lots of positive things. They're all incremental that will help to add to the earnings growth and sentiment for the sector. But let's not forget, if the GNU does not work, that will impact the property sector, as I mentioned, and have longer interest rates. Municipal charges as well is still a big issue. The other issue that we didn't talk about a lot is water supply issues. So water supply, big issue, but property companies are investing a lot. On average, they've got about 2 days of water supply, and most of them, they're aiming for like 5 days. So that when day 0 comes, if it ever comes, then you've got supply for that. And it's easy for you to let a space when you can supply water, you can supply electricity as well. Those are the costs that the property sector, they're spending on. And then the challenge that if GNU doesn't work, then there could be shift back to offshore investments with Regulation 28. So with that, I'll say thank you, and I will take it over to the finance ghost and Mark Tobin.
Great. So Over to you guys, and thank you, Keillan. That was a really great discussion. So without any further ado, just a reminder to everyone on the call, please pop your questions into the chat function and enjoy the discussion.
Thank you, Vanessa.
Thanks, Vanessa. Thanks, Keillan, for a really great presentation. I think there was some excellent slides in there with data that you kind of won't see elsewhere, or would take you a long time to pull out of all of the SENS announcements that comes out from the various REITs that was mentioned there. I think let's maybe start at the start when you flashed up, all the members that make up the SA REIT Association. I just want to talk about, when I look at, REITs internationally, we see a lot more specialized, or how will I put, emerging assets within REITs, internationally, whether that be healthcare, and that can be, hospitals, aged care facilities are a big one now. Data centers is a hot new kind of global REIT sector. Farmland, even in the US, I think there's one or two that do, farmland within a REIT. In a South African context, as the sector matures, because it's quite a young sector, the official REIT legislation hasn't been around that long if you can compare it to, say the US or Australia. Is there a kind of a feeling in the sector that we're going to see more of these specialist or newer REITs, or is there really any demand from, the PIC or the big pension fund guys to, have a locally domiciled, listed on the JSE exposure to those kind of assets?
Yeah, that's an interesting one. So the sector is looking and considering that. Even the JSE as well, they're exploring that opportunity. So most of these assets in South Africa, they are privately held or unlisted. So they're in the private equity space. So at some point, some of these funds may need to exit and then consolidate with other entities, and then to build a scale. So there's opportunities for that. But the function of the market timing, where like with the sector trading at 35% below NAV, you have to come in at NAV. So the valuation gap, as the market recovers, you will see those opportunities come through into the sector. There's talks around data centers, healthcare as well. Growthpoint does have a healthcare fund, but they're probably looking to list a few years down the line. Student housing as well, and then residential sector with the new sector that's been launched as well. There's opportunity for the sector. So there are opportunities, but it will take time for them to come through here.
Thanks, Keillan.
Keillan, maybe I can jump in there, and thanks so much for making the time available today and to bring this level of research, I think, to our retail audience. It really is great. So I want to start with a question that is very focused at our retail audience. And, a lot of people grow up and their parents say to them, buying a property and renting it out, that's the way to get on the wealth ladder. That's the way to create wealth. It's that typical buy to let investment. I think when I started GoSmell, I joked about it being buy a toilet, because that's often where your money goes if you don't, if you're not careful. Buy to let residential often doesn't actually work out. And I always think the REITs are just a much better place to actually take a look, and the liquidity, it almost scares people a little bit because they can see the share price moving every day. But the reality is that little flat you own somewhere that you're renting out, that price also moves every day. I guess you just can't really see it. So I guess just very high level. I mean, one of the benefits I look at is like the liquidity of the REITs. You can sell your shares very quickly, as opposed to being stuck in a buy to let. So just from your side, very high level, do you think this is a sector that investors really should be looking at, all types of investors, individuals, institutions, maybe as an alternative to some of the buy to let advice, that our parents gave us growing up?
So thanks, Ghost. So it's interesting that people tend to look just only liquidity. There's also look at the yields as well. That's difficult to get like above 10% yields when you look at residential. If you run on your own flat, and then amount of work involved, having to sit in body corporates as well, and then concentration risk as well, exposure to one tenant. I've got a friend of mine who's got an apartment. He hasn't had income for the last 6 months, been fighting it in the courts trying to evict the tenant. The law favors the tenants with the Consumer Protection Act. So concentration risk as well, the amount of work involved, sitting in body corporates as well, doing the repair work, maintenance, and that as well. It's just for what you get. I believe that you can get better exposure in the listed space. For example, we've got Octodec, they own apartments in Pretoria and in Joburg. They're trading at about 13% yield. They do all that work as well for you.
Keillan, I might maybe throw in a follow-on question from that. I know it wasn't in your deck, but I'm sure you've got a high-level view of it. In terms of, or we're talking about the PIC or the big pension guys or wealth managers, whatever, when they're pulling together, financial advisors pulling together portfolios for individuals, exposure to REIT / property, where does that generally fall? Is it 5%? Is it more on the 25%? Just given the kind of good income stream that tends to come along with it.
So that number has changed over the years. So during the good times, we saw pension funds using the Alex Forbes survey sitting at about 6 to 7%. That was a property allocation. And that's fallen. Last year, it fell down to below 3%. And then latest numbers up to end of June, you're looking at about 3%. It's mainly because of that property fell out of favor and then the market movement as well. And we may see that number start to increase with the example that I showed earlier on with institutional buying coming through.
Something I just want to touch on is the relationship between the REITs and typically the bonds. And you had a really great chart on there showing the returns in the property sector versus the bonds over various time periods. Property is often seen as a hybrid, right, between a bond and a sort of pure equity play. But if you look at the returns over time, sometimes property is the best performing asset class you could have chosen. Other times it's the worst. Obviously, over the long term, it should come out somewhere in the middle. But I think on your chart over 15 years, it was pretty close to the bonds, certainly not closer than one would hope to see. Would you say this really comes down to that relationship between the inflationary pressures and just, on costs and the demand for the space not being there in South Africa? We kind of had that last decade. You had another great chart in there about municipal costs as a percentage of income and how much that has really gone through the roof. Are those the sort of things you would attribute that relative underperformance over the last 15 years to? And do you think it can get better?
Yeah, so that's an interesting question. Is that property sector has been through some of the many issues where it's out of the property sector's control. If your municipal costs probably go up, maybe inflation, that would be easier. You had load shedding and then water issues as well. And most of those investments have been done by the property sector. And I believe we're probably seeing the West from that perspective, and then growth coming through as well. And what you find with property as well, it tends to trade at a premium to bonds when you've got positive growth, and then maybe at a discount to bonds when you've got negative growth. But the property sector now is holding on and hoping for good times for 2025, 2026. So in short, I think it will get better. We've seen most of the pain from the sector from various angles.
And if we just, somebody watching this presentation today and, they're trying to upskill on the REIT sector more broadly, and then they start maybe delving down into some of the members or the other REITs listed in South Africa, if you're kind of saying to somebody, you're going to start looking at a particular REIT, what would be, when you start to look at one, kind of what's the first three things you kind of go to in order to kind of get a general sense of is, good, bad, indifferent, maybe those kind of top three things, for people to start researching on a particular REIT?
Yes, so the key things is the quality of the portfolio in the markets that you save or you operate in. So dominance is the most important thing. So whether you dominate in that space, and then the tenant mix, diversification, very critical, as opposed to being exposed to maybe one or two tenants, as well as the balance sheet, how the balance sheet is structured to avoid having big maturities coming through, or maybe too much floating debt, then you're caught up in the market. And then the ability as well to recycle assets and look for new opportunities. And you have to look at where the sector is trading at, and then the yield versus that. If it's better quality, lower yield is acceptable. Lower quality, you can trade at a higher yield compared to the sector. But at the end of the day, all comes back to the management track record, what they've done as well to help produce better returns for the investors. And also liquidity is important as well. You should be able to, the whole point of being listed, you should be able to trade the shares, then trade in and out.
Something I want to touch on is the net asset value of these funds. And the reason people look at NAV is because the REITs typically revalue their properties. So NAV is supposed to be a pretty good indication of what happens if they sell off all their properties, settle all their debts, and return all the capital to shareholders, right? It's a bit like banks. But we see these big discounts to NAV, and that would imply that the share price is very, very undervalued. But then you look at the yields on some of these REITs, and the yields don't necessarily look that strong. So it almost seems like sometimes the NAV is a little bit inflated. If you kind of look at the cash that's coming out of these REITs and you try and look at the NAV yield as opposed to the share price yield, there's a bit of a disconnect there sometimes. I would imagine that's one of the things you look at when analyzing the sector. But is that a bit of a problem? Are some of these NAVs a little bit stubbornly high at times? They don't necessarily come down in line with yields as quickly as maybe they should?
Yeah, that's it's a very debatable question. Like we talk about this a lot in the market, but the main issue is around earnings growth. So you compare, so earnings outlook has been negative now. So the market tends to probably look at more short term. This is what happens. Earnings, I'm getting negative 2, 3, 4%. That affects the property valuations. The listed property valuations, and also the sectors compared to the bond yields. And let's be honest, bond yields have offered you higher yields, and then that coupon it's not going negative. Whereas property short term, you've seen that negative growth come through, and then the market will shift and say, oh, they have bonds compared to property. But then if you look at the underlying assets, which the market doesn't look at as well, because end of the day it's about what you're getting as an investor, is positive net operating income growth. And valuers, they don't adjust the property values every 6 months or every year. They tend to look through the cycle and look at net operating income growth. So at this stage, with bond yields coming down, values will still be stable. They don't overshoot or undershoot compared to bond markets. They tend to be long-term. That's why there's that disconnect between what investors are looking at in the listed market as the direct market. And the other point I mentioned earlier on is that valuers will use transactional evidence and see where the assets have been trading at. And we've seen assets trade at 7.5 to 8% yields this year. And talking to some of the buyers, they've mentioned that they're not the only ones who bid for those assets. There were 3, 4, 5 other bidders, some even below 7.5%.
Keillan, one from my DMs here, it's related to self-storage. I know storage was on the list there as one of the members, but they were just talking about, and I actually read an article about this on, I think the New York Times or Bloomberg last night, about the very low transaction volumes. I think they were saying it's down 36% year over year on residential sales in the US, which obviously the self-storage guys feed off of a lot, because as people change houses, buying one, selling another, that in-between gap of, having a storage unit for a month or two, makes up a large part of their customer base. So maybe just maybe touch on, how that would affect storage in the South African market with, these high interest rates also affect, the ability for people to get bonds, and how that affects maybe REITs more broadly when you've got people, not moving around the country or not moving to, different parts of cities where, they've filled out a mall here, thinking all these people are going to move here, and now suddenly nobody can get financing and everybody is kind of stuck waiting for a suburb to fill up that was, pre-COVID supposed to happen in 2 or 3 years, and it's now been dragged out over 6 or 7 years.
So storage has been doing quite well in South Africa. It's one of the top performers with the exposure just to UK and South Africa. And look at the net operating income growth, they've achieved like 14% growth over the last year, and vacancies are quite low. And it's an interesting sector is that it depends which market you are. I was renovating my place, as I mentioned earlier on, and I thought I was going to keep my stuff for 3 months, 4 months, and now it's been 2 years. And they said the challenge is that once you store stuff in the storage, it's difficult for you to take it back. So that's the other point. And also that it's not about just housing. People always relate storage to just housing. It's small businesses as well operating, and some of the retail as well. They use some of that space. That's why you've seen that strong performance on storage UK as well as in South Africa, whereas America as well, because it's a much bigger market and with lots of residential activity that side. But South Africa as well as UK storage has done quite well and some of the top performers.
Keillan, I've got a pretty interesting question here in my DMs, which talks to companies in the property industry that are not REITs. Now, there's obviously the developers, there's like Calgary M3, there's Baldwin doing construction, and that's fine. You know, there are one or two others, but you know, Fortress was the big one, right? The REIT into non-REIT. So I think let's talk about that. You know, has that turned out to be the disaster for them that many feared? My sense is no, but I'm keen to get your views. And then just to confirm, when it's not a REIT, the dividends are taxed like dividends from any normal company. Yeah, that's my understanding as well. So that answers that question. So let's maybe talk Fortress. You know, is it such a big deal to lose REIT status? Do you think they'll come back as a REIT? Do you think they might carry on?
Sure, that's yeah, interesting. That's been one of the topical things earlier this year. I guess for them, so not being a REIT, they mentioned that it gives them flexibility. But interesting that they're still paying out 100% of their earnings to investors as dividends, but they seem to enjoy that flexibility and less restrictions. But if you look at that, they're still a member of the SA REIT Association, so it could be a quasi-REIT in a way. But that's one thing we're watching out for the market, whether they will convert to a REIT later on, but it seems that could take time.
Keillan, one from me here. Sorry, I'm just trying to get it up my DMs. Probably another popular topic, you know, REITs who've had, you know, management agreements, you know, externally managed versus internally managed. And the question is, you know, how many REITs are still operating with a Manco structure on the JSE versus you know, the internally managed ones. I know we've had one or two conversions that have caused quite historic the multiples that were paid to finalize those agreements. But is the trend generally more to internally managed now? And you know, how many externally managed ones are still left?
Yeah, so the trend and the market prefers internally managed REITs. So in the mid-2000s, we had a couple of externally managed REITs, and that's changed over time to internally managed. The recent one, you've mentioned some of the recent ones, has been Beston Group, which used to be managed by Investec Bank, and they've internalized that management company. And then the one that probably stand out will be Octodec, which is managed by City Property. They extended their management company agreement, and looking at the fees, it's like they get a certain fee, so it's all in. They do everything in-house, no, so not in-house, externally at a fee, and then there's a hurdle rate. If you achieve certain distribution growth as well, then you get more. So what to look at as well is that the alignment with investors, because there's always a perception that if you externally manage, you bulk up the assets to get more fees. So the market watches out for that. And then the counter argument as well is that whether it's Investec Bank, they've got 24% exposure to Beston, and then the City Property or Wapnick family, they've got 35%, over 35% exposure to Octodec. So they also have skin in the game, but the market prefers externally managed REITs. So internally managed REITs, sorry, not externally managed. Yeah.
I've got a good one in my DMs here that I think is well worth doing. I'm going to actually combine two questions. So the first one talks to just M&A activity expectations for the rest of the year. Just broad question there. You know, what do you think it's going to look like in terms of M&A and the level of activity? Then there's also a question around REITs selling assets, which of course is the other big corporate action that they do. What would some of those reasons be for selling of assets? I mean, we've seen a lot of strengthening of balance sheets, reducing LTVs, you know, over the past couple of years. That's been a really good reason to kind of sell down the assets they can, get the debt down as interest rates went up. Do you expect to see that level of assets selling, you know, going into this new cycle now? And then just any commentary around the expected level of M&A as well. You had such a good chart up there about the number of REITs on the JSE and how much that's come down, how much M&A we've already seen. So any comments on that will be really helpful. Okay,
let me start with the M&A one. So what you've seen with the sector right now, everyone's focusing on their own businesses, fixing their balance sheets as well, selling off lower quality assets as well, and then recycle in some instances. That's been the focus of most of the REITs and property companies, as opposed to inheriting other people's problems. So balance sheets have been the key focus right now. M&A activity, you may see one or two, but not many. So the opportunity was there over the last year or 2 years when there was even bigger divergence as well in valuations, but just a matter of timing. So we may see one or two, but I don't see much M&A activity in this space. And then on disposals, that's likely to continue. And you've seen some of the REITs talk about capital recycling as well. Some they're selling local assets and then going offshore, or buying new assets as well within the local space. Like we've seen, let's say with Hyprop buy Table Bay Mall, based on buying a neighborhood shopping center as well. A little bit of capital recycling, but some of that are going into offshore markets. And Growthpoint mentioned in their pre-close that they're looking at about 4 billion of capital recycling, then 2.5 billion or so goes into investing into the existing assets, and then 1.5 billion into new assets.
Yeah, and we had SAREIT actually on here 2 weeks ago, I think, if I remember correctly, and they're also in an asset recycling program, buying assets off of MIRA, which I think got takeover panel approval yesterday, if I remember the sends, and selling off some other stuff. I want to go into the private market here now for a second, because I live here in Stellenbosch, and if I can tell you the growth in student accommodation in the last 9 and a bit years since I've lived here, I mean, it's absolutely exploded around Stellenbosch. And I don't think there's a REIT that has much exposure to that. I think maybe Growthpoint, I think, has some small exposure to it, but there's nobody with a major exposure to it. Do you follow that market? Give us a sense of what's happening, because I know, I read constantly here every January about students looking for accommodation, but I don't think it's a problem specific to Stellenbosch, Cape Town, Joburg. There seems to be a serious lack of higher education accommodation, dedicated accommodation for higher education students. So maybe just talk about yields in that sector, if you know of any, and kind of, it seems to me like it'd be a growth area within the property space. Yes,
it is. We did some work early on this year. So Growthpoint did a student housing seminar. So Growthpoint is in that space. They've got an unlisted, it's called Thrive Student Living. And then you have Momentum as well, or Aries Property Group that we have. They've been building that stake. And in the listed space, you can get some exposure, but not much, through SA Corporate. You've got Optodec as well, having some, and then a Growthpoint as well. So it's a potentially growing sector. There's just been issues or concerns around NSFAS, the student aid scheme, which just kind of takes away that kind of attractiveness of this sector, where investors at times can be hesitant. But talking to most of these players, there could be delays in payments, but they eventually get paid. But long term, it's a sector that's got very strong growth opportunities, because demand far exceeds supply. It's all about just NSFAS, so the government sorting out the payment system.
And yields in that sector, do they come out somewhere around, what the residential REITs tend to get, or do they see it as, kind of an enhanced residential yield?
Yes, so it's in South Africa, it's similar to the residential, approximately 9%, 10%, or maybe 11 in some instances, but maybe 9 and 10. But what you find in the offshore market is different in that residential will trade at a lower yield than student housing REITs. So still all this preference for more, it seems probably more stable, longer leases compared to student housing, but kind of similar in South Africa.
Okay, there's so much I still want to ask you. I know we're going to run out of time. I've got one in my DMs that I want to do quickly, which is, in your view, is it better to focus on the big diversified REITs or the more niche players? There's probably not a blanket answer to that, but anything you want to comment on there? And then your favorite sector for the long term. I knew a question like that was going to come up somewhere, so there it is. Could be worse. They could be asking for your stock pick, which we know is much harder to answer than favorite sector.
Okay, so I'll answer it using maybe some of the charts or tables I presented on. So what you found that the specialized REITs are the ones who are in a better space. They are paying out 100% of the earnings to investors as distributions. I guess it's a global trend. The market prefers specialization globally, where South Africa always operated as diversified REITs, but the more specialized, in my view, the better where there's focus rather than in being in many different sectors. So that's that. And then favorite sector. Favorite sector is not only just township and rural retail. It's been my favorite sector for the last year, 2 years, actually more than that as well. I would say the retail sector in general, as I mentioned, that you're seeing growth in sales, though the numbers just kind of cooled off somewhat, but long term, it's all about the ability to raise rents. That's number one. And then two, competition. Yes, there's a couple of shopping centers coming up here and there. There's a report that says 100. Not all of them is going to come through. But if you're in the right market, you're dominant and the retail is still expanding, I would still prefer the retail sector at this stage. And then select office market, still cautious, but I prefer retail.
Now, retail is my favorite as well, for what it's worth. Back to you, Mark.
Yeah, last one for me, because I think Vanessa's going to want some time to ramp up here, but it's a good one in my DMs as well. Question of, who's buying the assets from these REITs? Because I think maybe they're thinking of, these REITs, property is all they do all day, every day. So, on one side of the table, you've got a very sophisticated seller versus, somebody who's buying it who at the, rand values that these things are trading at are probably also like, quite sophisticated buyers. But, how do REITs offload their properties? Who are the kind of natural buyers of REIT properties? Is it other REITs? Is it, high net worth guys? Is it, other REITs who would, it's core to them, but it's not core to, another REIT?
Okay, so maybe other risks probably happen with EPRA selling to Spear. EPRA looking for opportunities offshore, and that's probably the one that stands out. But most of the disposals is private buyers, pension funds is number one, and then two, like business operators as well, like some consortiums of people saying, okay, we want this asset. There's an emotional attachment or value to these assets, and then some businesses as well who are like kind of want to own the assets because they know they've got a business that's going to be there for 10, 20, 30 years. They'd rather own the asset rather than rent it out. So we're seeing quite a diverse pool. And surprisingly, they're buying at 7-8% yields, 9% yields.
I see Vanessa's in here now, so we definitely...
Wait, Vanessa, wait. One last one, please. Last one.
Go ahead.
It's quick. Keillan, is the Pick n Pay issue overblown? So Hyprop didn't pay me a dividend and they blamed Pick n Pay and it still hurts so bad. Is it overblown? Is this Pick n Pay? I mean, I read it in every single REIT communication. I almost control F for Pick n Pay to see if they make reference to exposure. What's your view on whether it's a problem or not? Bearing in mind, Pick n Pay is about to successfully raise their rights offer, which is fully underwritten.
Yes, so good question. I guess on Hyprop, I guess that wasn't, from what it wasn't communicated very well. Pick n Pay, yes, not doing well. They're going to cut the number of stores, but opens opportunities for not just other food retailers, whether it's pharmacies, pet shops, discounts. So in fact, some of the landlords, they want to Pick n Pay to reduce their exposure because they've been trading less than what they're supposed to, and they see better opportunities. So it's a positive and a negative, and some are happy to Pick n Pay to cut the space by half and give it to somebody else.
Yeah, we better get back to Vanessa before we get into trouble.
That was a fantastic discussion. So to everyone who was on the call today and who participated in Unlock the Stock, thank you very much. But a special thank you to the South African REIT Association and also to Keillan for making the time available. It really was a good discussion. Thank you. We hope you've enjoyed this event. It will be on the Unlock the Stock YouTube channel next week. And as a reminder, our next session, we've set you July is very busy. So same time next week, the 25th of July, we feature another returning company, which is Teresa. So from my side, thank you so much, Keillan, and the South African REIT Association, and to everyone who participated on the call today. Thank you so much and goodbye.
You're welcome. Thank you, everyone.